Let me introduce Yogesh. Hi, Yogesh. Now you can
Hello.
take it from here, and let's go deep into transfer pricing laws, and let's hope that with our LinkedIn Live, today's LinkedIn Live, more and more businesses will get aware in terms of why transfer pricing is required in their business, and how do they navigate this complex structure in their global business. Over to you, Yogesh.
Hi, so thank you, sir, for inviting me for this discussion, and a very good afternoon to all our viewers. Let's start the transfer pricing discussion with the slide. Okay, so let's go through the index, which gives us a brief walkthrough of the topics which we are going to cover in today's discussion on transfer pricing. We'll start with the background of implementing transfer pricing. Here we will discuss the background with the example of income and expenses. We'll also go through the meaning and the principle of triggering transfer pricing. Then we'll go through the transfer pricing non-applicability, under what circumstances the transfer pricing provisions will not apply to an SSE. The basis of determining associate enterprise, which is very important in this discussion, is covered under section 92A. And what is international transaction? What constitutes specified domestic transactions? What is arm's length pricing and methods of computing it? We'll also go through the maintenance and keeping of information and documents under the transfer pricing regulations, which is a very key issue, and the reporting of international transaction and specified domestic transactions under the transfer pricing regulations, where we will go through the threshold limits, the forms which are prescribed for an SSE to file, and the stringent penalties if under the circumstances of non-compliances. So let's start with the background. So here, suppose I've taken an example of expense. So there is an enterprise as Unilever UK, and there is an enterprise HUL in India. Both of them are associate enterprises. So what happens that the Unilever UK sells a soap to Indian associate enterprise at rupees 10. The same product is sold to a non-associated enterprises at rupees 6. So there's a difference in the pricing. The UK is selling the good to the associate enterprise at rupees 10, while the same good is being sold to a non-associate enterprise at rupees 6. So in the Indian books, the purchase price at a higher price, resulting in overbooking the purchase expenses and eventually paying lower taxes in India. So the consequence of this would be that the authority will disallow for expense of the Indian entity and charge tax on it. Next, we'll check the example of income. So suppose there's an enterprise, Tata Motors India, and its associate enterprise is there in the Jaguar Land Rover in the UK. Both of them are associate enterprises. The Tata Motors sells the car formula in exchange of royalty of rupees 10 crores to the Jaguar Land Rover UK, while the same car formula is sold at a price of rupees 50 crores to the non-associate enterprise. Suppose the associate enterprise is located in Thailand. So there's a disparity between the same product with regard to the pricing. So here what happens that the India books the income from UK lower than the income received from Thailand. As a result, sale of India is understated, which eventually leads India paying lower taxes. So the consequence of this would be that the authority will add income of rupees 40 crores to the Indian party and charge tax on it. The other party, UK, cannot claim allowance of expense just on the ground that its associate enterprise, which is the India, the Tata Motors, income was increased. So as a parallel expense should also be increased to the UK party. So this is not allowed under the transfer pricing regulations. So just on the ground that the counterpart associate enterprises income has been enhanced by the income tax authority and tax has been charged on it, the other party cannot say that my purchase, my purchase or my sales would also be, enhanced, and my tax liability should come lower. That cannot be done under the transfer pricing regulations. So this was the background. I've taken the income and the expense example to establish, the base of the transfer pricing. Let's go through the meaning of the transfer pricing. Transfer pricing relates to the determination of correct market price, and this correct market price is called the arm's length price. The section 92 establishes the principles of triggering transfer pricing. Here what happens that if the transaction takes place between the associated enterprises, the transaction should be an international transaction or it can be a specified domestic transaction. The transaction should involve sale of goods or provision of services or both. Expenses incurred, including interest on loan. Say, with regard to the, if I would like to cite an example for the interest on loan, say one associate enterprises gives loans to the other associate enterprises at 24% interest rate is paid. So while in the market, it's just the 9%. So this also constitutes, kind of international transaction, and there's a disparity between the rates. So this is also covered under the principles and the transactions, and the next would be the allocation or the apportionment of cost or expenses. So all these circumstances, if they collate, then transfer pricing provisions would trigger. Now let's analyze under what circumstances the transfer pricing provision will not apply. So if the determination of a transfer price results in reducing the income chargeable to tax or increasing the losses of the SSE, then the transfer pricing rule will not apply. Here I would like to give an example. Suppose a transaction has incurred between two associated enterprises. Suppose it was of 50 crores. And when the TPO or the AO went through the, analyzing the arm's length price of this transaction, and they conclude that the arm's length price is 40 crores instead of 50 crores. So this would reduce the income. So in such circumstances, the transfer pricing provisions will not apply. Another is for the domestic transaction, where if the aggregate specified domestic transaction does not exceed rupees 20 crores. So a threshold limit has been, prescribed for the specified domestic transaction, which is 20 crores. So in these two circumstances, transfer pricing provision will not apply under section 92(3). Next is how to determine associate enterprise. This is very important for all of us. So the basis of determining associate enterprise is given under section 92(a). So the criteria one is that one of them is a non-resident and the other can be a resident, or both of them are non-residents and the income of either of them is assessable under Indian Income Tax Act. This is the first criteria in case of an international transaction. The second criteria, which there are some 12 to 13 criteria which we will go through, that has to be also that has also to be established in order to establish a associate relationship, which are the equity holding, the equity in two or more enterprises, the loan, guarantee or borrowing, governing body by enterprises, governing body by same person, manufacturing, processing of goods, raw materials. So if any criteria is satisfied, then the two or more enterprises will be called associate enterprise. The next is like sale price and conditions to sales, controlled by individuals or relatives or jointly, controlled by HUF members or members relative or jointly controlled. I think this is, we'll check this, the deemed to be associate enterprise. So if any of this is just a brief, we will deep dive into all these criteria. So if any of these criteria is satisfied, then the two enterprises will be called associate enterprises. And if there happens an international transaction between them, then transfer pricing regulations will come into the picture.
Yogesh, I think we should go back on this associate enterprise definition, because the pillar of transfer pricing provision is actually to determine whether the two enterprises are associated or not. In the sense that two enterprises are connected or not, related or not, And if the taste of water under transfer pricing is being proved, then both the enterprises will be associated. And the moment two enterprises are termed as associated enterprises, then all the provisions of transfer pricing law will apply to the related party associated party, and all the compliances needs to be done. So I think
Absolutely.
if I just go back in terms of what is criteria number one, the criteria number one is that one of them has to be non-resident and other can be resident. So very
Correct.
interestingly, can be resident. The meaning of this is that not mandatorily the other has to be resident. And many people think that if both of our related party are outside, then there is no
Mhm.
transfer pricing law, right? So
Right.
so it can be, and both of them are not, or both of them are non-resident, and income of either of them is assessable under income tax act. So basically what does it say? Either one can be outside India, or if both are outside India, then one of them, their income has to be taxed in India under
Correct.
other provisions. It can be through poem, or it can be p, or it can be through other DTA provisions. Their income has to be taxed in India. So if that is the case, then that is associated. And criteria number one is that you are associated either by way of equity holding or by way of equity in two or more enterprises, that's the cross holding, or there is a loan arrangement, guarantee or borrowing, or governing body means that there is a control over one enterprise over the other enterprise in terms of their survival or day-to-day activity or economic benefit, right?
Right.
Or dependency is big. So number one and number two is because of the equity holding.
Right.
Number three to number eight is because of control. Now,
Right.
and all these are economic control or governing control. For example, loan is economic control. Now, you have given loan to someone, and the
Mhm.
quantum of the loan or the arrangement of the loan is such that the other party is totally dependent on you. So it can be loan, it can be guarantee or borrowing. So you have given guarantee for your, so even though there is no equity holding, but there is a guarantee or borrowing given, then there can be related party, governing body, common shareholder, common board of directors having control by a different method, by agreement, by way of uh, uh, indirect way of control, or the one party is dependent on other in terms of manufacturing. Why I'm going deep into this? Because we all feel that okay, there is no common shareholder, there is no common director, so there is no associate enterprise, or both of the enterprises are outside India, there is no associate enterprise. I think this is very, very important to understand. We can go to the next slide, Yogesh.
Absolutely, sir.
So just go back just to continue sale. So if you can determine the sale price of the other, or if through indirectly they own, through jointly, through relatives, or through HUF control. So basically, if you go to the crux of how do you determine associate enterprise? So I think we have to unlearn the idea that associated enterprise is only because of cross shareholding. The associated enterprise is there if there is a control. And
Right, sir.
control can be from different ways. Either it can be economic control, it can be ownership control, it can be management control. If there is a control which is substantial on other party, through which control they exercises the control and determines the economic behavior in terms of pricing or in terms of how they operate, then both the enterprises are associated enterprise. So this is the pillar of the transfer pricing laws as far as I am concerned.
Absolutely, sir. So let's, sir, analyze each of these, criterias. So the first one is for the equity holding, which is the most simplest form. That if one enterprise is holding 26% or more of the equity of the other, then both of them would be called the associate enterprise. This is the most simplest form which all of us know. And let's analyze the other. If there is, it doesn't mean that, if 26, if one enterprise doesn't host 26%, it will release the relationship not to be associate enterprises. There are the other, criterias from, 2 to 12. Let's check each and every one of them. So the other one is of the equity in two or more enterprises. So suppose if there is an enterprise A which has an equity holding in enterprise B and also in enterprise C. So A and B are associate enterprises by by the equity holding, and A and C is also associate enterprises, but there is no holding between B and C. So under the transfer pricing regulations, the B and C would also be considered as an associate enterprises. That is what this chart explains us. That is enterprise A holding equity of more than 26% of other enterprises, say B and C. Yes, the other enterprises, which is the B and C, are associate enterprises among themselves. This is what this chart says us. Let's analyze the other criteria from 3 to 12, which is of the loan. This criteria says that has one enterprise given loan to other? If yes, then we have to check the threshold, which is that is loan given more than 51% of the book value of the total assets of the loan receivers enterprises. The enterprises who receives the loan, if the quantum of loan is 51% or more of book value of the total assets, then the giver and the receiver enterprises would be deemed to be associate enterprises under the transfer pricing regulations. This is what the loan criteria suggests. It comes with a threshold limit which is of 51%. This has to be evaluated. Next is guarantee or borrowing. So has enterprise B taken any borrowings? Suppose outside, not from enterprise A, but from outside. If yes, then has enterprise A given guarantee of 10% of its total borrowing? So here also a particular threshold limit has been prescribed. That if 10% or more of the guarantee is given by one enterprises on the for the other enterprise, then both of them would be called associate enterprises, even though there is no equity shareholding, there is no loan given, as we have studied in the above criteria. Still, if the guarantee provision is satisfied, then both of the enterprises would be called the associate enterprises.
Right. So I think as we were discussing earlier also, guarantee or borrowing is also important. Just go back. So now we are getting into in detail in terms of all those nine criteria: loan, guarantee, equity, or cross holding. Right.
Correct. Right.
Right. Right. And this is very self-explanatory in the sense that if you given a guarantee of the, so if I have, what I have understood, that if I have a loan of 100 CR and if you have guaranteed a loan of more than 10 CR on my behalf, that somewhere we are related.
Absolutely, sir.
So I think that 10% is very, very important now. And this is very, very common in business parlance, wherein out of friendship, out of a common community, out of common group, people just say, I will guarantee this loan to you while taking bank loan. And no one even notices this fact. On the bank loan paper, they just write this entity is guaranteeing this loan. And most of the case, it might be more than 10% of the total loan.
Yes, sir.
No one goes and sees whether they are a related party or not. And now with more disclosures coming in, and the implication of transfer pricing will become very, very important, right? So this is very, very important.
So let's take the fifth criteria, which is of the governing body of an enterprise. So in case of director or governing body, if the appointment is made by other enterprise, if yes, then both of them would be called the associate enterprises. So on one side, the director or the governing body is given. On the other side, in case of one or more executive directors or executive member of the governing body, if the appointment is made by the other enterprises, say enterprise A appoints the governing body of the enterprise B in terms of whether it be the director or whether it be one or more directors, then both of them would be called the associate enterprises.
Right, right, right.
The next one is the governing body by same person. So in case director, again it's the if the same person is appointing the director or the governing body, or one or more executive directors, of executive members of the governing body, then both of them would be called the associate enterprises. The difference between the the last criteria and this is that the here the appointment was being made by an enterprise of the other enterprise, and here the appointment is made by the same person of the other enterprise. Next is the of the manufacturing or processing of goods. Here what happens that if is manufacturing processes or if is manufacturing or processing of goods is wholly dependent on other enterprise. If yes, then they are associated enterprise. So such dependency can come in the form of use of know-how, patent, or the copyright, trademarks, license, franchisee, or any other business or commercial rights of similar nature, or any data documentation. So it's more kind of dependency of one enterprise on other enterprise in relation to their manufacturing or processing of goods. If such dependency comes into the picture, then both of the enterprises would be associate enterprises, even though there is no equity shareholding, there is no loan, there is no guarantee given for the loan or the borrowings, or there is no appointment of the governing body. If this criteria is satisfied, that the dependency of manufacturing and processing of one enterprise is dependent on the other, yes, they are called the associate enterprise. The next one is for the raw materials. Here again a threshold limit is given that if 90% or more of the raw material or supplies of one enterprise is provided by the other. If it's yes, then they are associate enterprise. So in the earlier slide, the manufacturing or the processing of goods were dependent on the the know-how, the patent, the copyrights, or the trademarks. Here it's more of kind of raw material. So, and there's a threshold limit is also given, which is the 90%. The next is for the sale price and conditions to sales. So when sales are made to other enterprise, are sale price and other conditions to sale determined by the other enterprise? If it's yes, they are associate enterprise. So here the sale criteria is being governed by the other enterprise, or the the conditions in associate or the conditions associated with the sales. The next one is for the control by individual relatives or jointly. An individual control one enterprise and practices controlling on the other enterprise by himself or through relatives or jointly. This is the one of the most common used to I mean this was the one of the most common modus operandi which SSC used to take, where one SSC used to be the owner of the enterprises in India, and he used to make the his wife the owner of the another enterprises which is located in Dubai. So if there is control by individual, so if such kind of if such kind of appointment is made, then both of the enterprises would be called the associate enterprise. Again, we'll be discussing the control by HUF member or member relatives or jointly. So a member of HUF or relative of such member are jointly controlling the other enterprises. If yes, then they are associate enterprise. So suppose there is an enterprise which is governed by an HUF in India, and one of its member becomes the the owner in the other enterprise located in Dubai. So here the criteria is of HUF members, or maybe the if it's not the HUF members, then maybe the relatives of the HUF members. If they become the owner in outside India, then these two enterprises would be called or termed as associate enterprises and would be governed by the transfer pricing regulations. Okay, the second, the 12th one is of the this is here what is happening that if 10% of the profit sharing interest in firm or AOP or BOI controlled by other enterprises, if yes, then they are associate enterprises. So suppose there is a foreign enterprise who has the 10% of the profit sharing in the firm AOP or the BOI located in India, then both of these enterprises would be called as associate enterprises. So these were the 12 criterias. Apart from the 12 criterias, there is a particular criteria which is given under which the two enterprises would be deemed to be associate enterprises, which is mentioned in section 92B. So what happens over here is that it covers those transactions conducted between two unrelated party with the intent of influencing pricing between two associate enterprises. Then such transaction shall be deemed to be transaction between two associated enterprises. Here in this chart, I have explained that suppose there is a company A in India and there's a company B in Australia. So they are already associate enterprises among themselves. Company A wants to sell goods to company B, whose ALP is 200 crores. But company B wants that to be at a price of rupees 80 crores. For this, a dummy company C is opened. Where it is opened? It is opened in New Zealand. So what happens here that the company A transfers the goods to its unrelated party at rupees 80 crores for further transfer it to the company B, which is located in the Australia. And the company C transfers the goods to B at rupees 80 crores. So under these circumstances, the conclusion of this is that if it is proven that the transaction between A, which is the India, and the B, and the C, which is in the New Zealand, was controlled by company B, the other associate enterprises located in Australia, then even though A and C are unrelated enterprises, they will be deemed to be associated enterprises, and hence the transaction will be international transaction and shall be governed by the transfer pricing regulations. Next is what is international transaction? So in a simple word, I would say that every transactions between two enterprises, most of them, almost all of them, would be an international transaction, whether be it in the form of purchase or sale of goods or services. Likewise, so what this slides explain us, let's read out. The scope of international transaction is very wide under the transfer pricing. It constitutes of transaction between two or more associated enterprise. International transaction can be of the following nature. Here, the transaction head is given, and under each transaction head, I've described the transaction type. So, suppose if there is sale, purchase, transfer, or lease, or use of tangible or intangible assets, that will also be that will constitute as an international transaction. If there's a provision of any services, including provision of market research, market development, agency marketing, legal, accounting services, etc. Likewise, for the capital financing, if there is a lending or borrowing, whether short term or long term, any type of advance, payments or receivables, or any debt arising during the course of the business, then that will also constitute as an international transaction. The list is more. If there's a transaction impacting profit or losses, which includes any other transactions having a bearing on the profit, income, losses, or assets of such enterprises, that will also constitute as an international transaction. If the international transaction will also include the transaction related to restructuring. So a transaction of business restructuring or reorganization entered into by an enterprise with an associated enterprise, irrespective of the fact that it has bearing on the profit, income, losses, or assets of such enterprise at the time of the transaction or any future date. At any future date. So all these transactions will constitute as an international transaction between two or more associated enterprises as per section 92B.
So this is the second pillar of transfer pricing provisions. The first pillar was to determine whether two enterprises are associated or not, and the second pillar is to, once two enterprises are associated, then what are the transactions which will be included under transfer pricing ambit. Now, if you start reading point number 1, 2, 3 in terms of tangible, intangible assets, so purchase, sale of tangible, intangible assets, any services which is being given, market research, development, accounting, legal, borrowing, any transaction with regard to borrowing, also in terms of guarantee also. The fourth point is very, very interesting, Yogesh, which says anything which impacts profit and losses.
Yes, so most of the items.
So you are specific. The government is becoming specific, and when they realize that maybe they will miss out anything, then they suddenly will say that, okay, fine. Now it also includes anything which impacts profit and losses. And we have also discussed that transfer pricing will not be applicable if there is reduction in losses, profit, or increase in losses. So basically, transfer pricing will not be invoked there. And the fifth point is relating to any restructuring which we are doing. So I think with this, we know the definition of associated enterprises, and we also know what kind of transactions which are included under this ambit. Yeah.
Yes. So what constitutes specified domestic transactions? So specified domestic transaction, here what happens that the transfer pricing is, is also bringing into its ambit the domestic transactions. So let's analyze. It is given in section 92BA. The provision of transfer pricing shall apply to specified domestic transaction if the aggregate book value of the two or more entity transaction value exceeds rupees 20 crores of the eligible businesses. So two criteria are given under the specified domestic transaction. The first, it has to be there's a monetary threshold limit which is based, which is prescribed as rupees 20 crores. And second, the two enterprises, the one of which the should be carrying on any eligible businesses. So what are those eligible businesses? Eligible businesses means those businesses covered under section 80 IA, IAB, IAC, IB, IC, IE, and section 10 AA. So let's see an example of eligible business under section 80 IA. So a group entity has two units. Suppose one unit is eligible unit whose profit is 100% exempt, and another non-eligible unit which is not covered under section 80 IA and is taxable at 25% rate. So in order to reduce the profit and pay less taxes of non-eligible unit, transaction is made between eligible and non-eligible unit so that the profit of the eligible unit is increased, which ultimately exempts from the tax. Such transaction will attract the provision of transfer pricing, and transaction will be re-evaluated at arm's length price and tax will be levied. So this is mainly focusing on the group entities where one entity of the group is absolutely tax exempt, and the other one is there is a tax which is 25%. So all in all, what happens that the profit is shifted from a higher tax bracket rate to an entity where the tax is either low or the tax is absolutely exempt on the profit. Moving on to the next example for manufacturing and non-manufacturing unit. A group entity has a manufacturing unit which is taxable at, so here an example has been taken on the difference between the tax rate of the two entities. So let's continue with the example. A group entity has a manufacturing unit which is taxable at 15% tax rate under section 115 BAB, and another non-manufacturing unit which is taxable at the rate of 25%, which is a company. And the transaction is taken between them to shift the profit of non-manufacturing unit to the manufacturing unit so that the group entity pays less taxes, as I was discussing before. Such transaction will attract the provision of transfer pricing, and transaction will be re-evaluated at arm's length pricing and tax will be levied on that. So this is the crux or the definition of the specified domestic transaction, which is defined under section 92BA. So next we'll be briefing on what is arm's length pricing and the methods of computing it. So what is arm's length pricing? Transfer pricing means determination of correct market price. So basically arm's length price is the correct market price. If you will relate my examples, my previous examples where the Tata Motors were selling the car formula to its another associated enterprises on rupees 10 crores, while the same car formula was being sold to another non-associated enterprise which was 50 crores. So in this case, the actual or the correct market price was 50 crores. So this is what is all about the arm's length pricing, which says to pick the correct market price. So for this purpose, there are methods prescribed. The most appropriate method can be used to determine the arm's length pricing. And yes, there is there's a gap or the variation given that if the transaction happens between two wholesale, where the entity is engaged into the business of wholesale or the retail, then a variation of 1% and the 3% is allowed between the actual transaction price and the arm's length price. So this variation or this gap is given under the provision of the transfer pricing. And yes, section 92C prescribes us the methods of computing transfer pricing, which are the comparable uncontrolled price method, the most common, the cup method, the resale price method, the cost plus method, the profit split method, transactional net margin method, the other method as prescribed by the board. And yes, there can be a circumstance where more than one arm's length price is computed. So under that circumstances, Rule 10CA has been defined, where which prescribes that how an SSE can pick one arm's length price out of more than one.
I think this is very important. I mean, in this, they are giving the methods of doing the transfer pricing calculation,
Yes,
right? How do you determine the transfer pricing as such, and
absolutely.
between the two enterprises to compare whether the transfer pricing is at arm's length or not? Have we explained what is arm's length?
Yes, sir. Arm's length pricing is, as I mentioned before, that it's it's a market price that has to be determined.
So basically, the most easiest and the common way of defining what is arm's length price is basically a price which is an uncontrolled price in an uncontrolled free world. So the price which you would have incurred when you have done business with an enterprise which is not your associated enterprise. That is
Yes.
the price which the government expects you to do business with your related party also, so that there is no erosion of tax base for India. And there are these methods to determine whether the pricing which you have entered into is at arm's length or not. Yeah, so we can move ahead.
Next is of maintenance and keeping of information and document under section 92D, which is very important. These information or documents are categorized into three: the general information, the master file, or the country by country report. So all these documents are, has to be maintained under different circumstances, under different threshold limits. And these documents has to be maintained for, 8 years from the end of the relevant assessment year. So let's see what's the general information. Here, what happens that every person entering into international transaction or specified domestic transaction shall keep and maintain such information and document as may be prescribed. In case of a foreign associate enterprise, these documents may include memorandum of association, article of association, certificate of incorporation, details of foreign branches, last 3 year financials, etc. These are also called as local files and are required to be furnished on demand to AO within 30 days. And these 30 days can further be extended by another 30 days on request of the SSC. And these records or the documents are required to be maintained if the aggregate value as per the books of international transaction exceeds rupees 1 crore. So a threshold limit again has been prescribed for maintenance of these documents, which is 1 crore. Next is of the master file. So this now master file or country by country report, all these are, more enterprise specific. Here, what happens that if an entity is a constituent entity of an international group, then it shall keep and maintain such information or documents as may be prescribed. The documents maintained over here are called master file. These master files are required to be furnished every year, whether or not the international transaction has taken place. So if you are a constituent entity, then you have to maintain all the, documents and the information as prescribed under the transfer pricing regulations, regardless of the international transaction, which was given, on the in case of the local files above. The next is for the country by country report. The multinational enterprises would be required to provide information on their global allocation of profit, taxes paid, and certain indicators of economic activity among the countries in which they operate. So these were the three, category of the enterprises, or you can say that the information or documents which these three category of enterprise has to maintain. And there's a time limit also prescribed that for the 8 years all these documents has to be maintained. So suppose if the local file is not maintained, and if the AO calls and 30 days limit he will give, and we can extend that 30 days limit to another 30 days. So within 60 days you have to present all these local files if your international transaction exceeds the monetary threshold limit of rupees 1 crores. So these documents or the information has to be kept and is very important, especially in case of master file also, where there is no threshold given. In case of country by country report, where there is no threshold limit is given. So moving forward to the reporting of
Just one point, there is a confusion in the minds of and many professionals also, that if your transaction is less than 1 CR, you don't need to maintain anything.
But no, sir, but in case of, if you are a constituent entity, then you have to maintain it.
Right, right. Even if you're not a constituent entity, then also from a normal business parlance, because this is just specific to transfer pricing. In a normal business parlance, each and every expense or each and every revenue details needs to be maintained properly, and there is a backup document proving in terms of genuineness of that expense or that revenue, right? So
Absolutely.
so what we suggest to our clients is that if your aggregate transaction is more than 1 CR, then you have to do a transfer pricing study, right, in detail. And otherwise you have to maintain the basic documents and details to prove that what you have done is in the normal course of business, right? I just wanted to make that point. Yeah, move ahead.
So reporting of international transaction and specified domestic transactions. Here we will check the forms required, the monetary limit prescribed for submission of those, or the filing of those forms, and the penalty if in case of non-compliance of the reporting or the filing of the forms. So let's say how to report international and specified domestic transaction. The first form is the form 3CEB. So if an entity undertakes a specified domestic transaction or international transaction, Form 3CEB must be filed along with the income tax return. There's a relaxation given for the domestic transactions, which value does not exceed rupees 20 crores. This form is a report which is furnished by a chartered accountant under section 92E. The form has annexure, which is divided in part A, B, and C. Part A requires detail of the SSC, and part B requires detail about the international transaction with the associate enterprises. Then the part C is solely dedicated for the specified domestic transactions. The due date for filing of Form 3CB is 30th November of the assessment year related to the previous year for which the report is to be filed. And there's a penalty also attached in case of non-compliance with the requirements under Form 3CEB. These penalties are divided into three categories. For non-furnishing of a report, which is the Form 3CEB, penalty of rupees 1 lakh will be attracted. In case of inadequate information, fine of 2% of the transaction amount will be attracted. And in case there is an error in the information provided, there is a penalty of 2% of the transaction amount. So these are the penalty associated with the Form 3CEB.
Now, this is very, very important, Yogesh. And even if you are doing 1 rupee international transaction basis, which is with related party, you have to file Form 3CB, even for a 1 rupee transaction. And the penalty is very, very stringent and very massive, and the government takes it very, very seriously. The limit of 20 CR is only for domestic related party transaction.
Right.
And you have already stated the timeline to file Form 3CB, and this is online, which needs to be filed online with the department. Earlier, we used to do manual submission, but now this is online. Right.
Moving forward, for the master file, there are there's a form called which is Form 3CEAA. It has got part A and part B, and there's another form which is Form 3CEAB. So let's read about each and every form and its part. its applicability, the due date, and the penalty attached. So every constituent entity, once again, I recall that the master file is to be, filed or has to be maintained by the constituent entity. So every constituent entity of an international group, irrespective of threshold applicability, whether entity is resident or not. So this has to be, filed. And the due date is on or before the due date of filing of income tax return. And for the part B of this form, again, the constituent entity designated by group only if the prescribed threshold is met by the international group. So here I've given a reference to the refer note, which describes the threshold limit. In the note 1, we can see that there's a threshold for master file compliance for form 3CEAA part B and 3CEAB. So a consolidated group, if a consolidated group revenue for the accounting year exceeds rupees 500 crores rupees and aggregate value of international transaction during the accounting year exceeds rupees 50 crores rupees, or in respect of intangible property during accounting year exceeds rupees 10 crores. So these are the two, criteria which has to be fulfilled for filing part B of the form 3CEAA. And the due date prescribed over here is on or before the due date of filing of income tax return. For the form 3CEAB, in case of multiple, constituent entities in India by designated every designated constituent entity has to file Form 3CAB, and the due date prescribed over here is at 30 days before the date of filing 3CEAA form. And the penalty over here is a very stringent penalty which is given under section 271AA subsection 2, which is rupees 5 lakhs. Prescribed authority may direct to pay such penalties. So this was in relation to the master file for the constituent entities, the due date, the penalty, the threshold limit.
Yeah, we can move ahead.
Moving forward, it's about the CBC report, the country by country report. Here, let's first refer to the note number 2, which is the threshold for CBCR compliances. Here, the consolidated group revenue in preceding accounting year, if it exceeds rupees 5,500 crores, then CBCR reporting would be required. Under the form 3C, yes, and the forms which are for the country by country reporting are the 3CAC, AD, AE. And the applicability criteria are that the intimation of details of parent entity or alternate reporting entity of the group which will file CBC report. This is the applicability criteria, and the due date for this is at least 2 months prior to the due date of filing form 3CAD, which we will read in the next, the next form is the form CAD. So every parent entity or alternate reporting entity resident in India or the constituent entity in India in case of country in which parent entity is located does not have an agreement of exchange of CBCR with India. And the due date for this is within 12 months from the end of the reporting accounting year. For the form AE, in case of again multiple constituent entities in India and country of parents entity or alternate reporting entity does not have agreement for exchange of CBCR with India by designated constituent entity which will file form 3CEAB. And here the due date is within 12 months from the end of the reporting accounting year, which is the assessment year. And the penalty for non-compliances for the CBC report is given under note 3. Let's read. The penalties for non-compliances with the requirements of CBC reporting, which is given in section 271 GB. The non-filing of CBC report by excuse me, non-filing of CBC report by Indian resident parent company or alternate resident company is under form 3CEAD. It's 5,000 per day up to 1 month from the due date. Rupees 15,000 per day beyond 1 month from the due date, and rupees 50,000 per day for continuing default after service of notice. This is very stringent. And not furnishing the information called for by the Indian tax authority within the given time limit, 5,000 per day up to service of penalty, order or rupees 50,000 per day for default beyond date of service of penalty order, and furnishing inaccurate details or non-filing of corrected report within 15 days, it's rupees 5 lakh straight. So this was all about the penalties if an enterprise is not in non-compliant with the CBC report.
As I said, that this is very stringent. The government is very stringent in terms of implementing transfer pricing provisions. In fact, transfer pricing litigations related to transfer pricing were most in the initial years. I think from 90s to 2010, 15. Now it has got reduced because things have settled a bit and things have become little standardized. Right.
Absolutely, sir. So we are done with our slide for the transfer pricing.
Okay. So I think this is a good presentation which we have been able to do today. And this basically covers the scope of transfer pricing, what is the related party, who are related party associates, what are the transactions which are included in it, what are the reportings which we need to do, and also penalties if you are not able to comply with the provisions. And as a firm, we have that expertise of working with multiple global entities and helping them to do transfer pricing compliance. I just take a couple of minutes and explain in terms of what we as a firm we do. So there are four pillars of work which we do. One is cross-border structuring, wherein transfer pricing includes. Then we also do fundraising compliance and due diligence. So this is corporate governance and financial control, and we also do some transaction advisory and IB. Been working with most of the unicorns in India and globally. We have global offices. And I think moving ahead, if you have any queries or anything which you want us to help you on, we'll be more than happy to do that. With this, we would want to say bye to you for today. We have got some questions, so we will come back to you on that. And take care of yourself, and we will come back soon with more LinkedIn Live as we suggest. Thank you for joining in today, and thanks Yogesh. Thanks everyone for watching this.
Thank you, sir. Thank you.
We will come back soon on this. Thank you.